In this class, we'll be looking about foreign exchange market. What is foreign exchange market? So, foreign exchange market is the largest financial market in the world. Here, banks and other financial institutions were authorized to carry on foreign exchange transactions. They form part of this market. And in this market, exchange rates will be quoted. It's nothing but one country's currency will be converted into other country's currency. And here in India, the Forex markets are in Mumbai, Kolkata, Chennai and Delhi. That is all the metro cities. And with the effort of and with the support that is provided by RBI, these centers have been extended, that is to Kochi, Bangalore, Ahmedabad and Goa. New centers of Forex have been set up in these areas. So these are the features of Forex market, that is location, size of the market, 24 hours market, efficiency, currencies traded. So it's nothing but it speaks whether this Forex market has physical existence as in the case of stock market. So this Forex market, it is also called as over-the-counter market. So in this market there is no physical existence where participants they can meet and execute the deals. The participants, that is banks and brokers, they can operate this foreign exchange transactions only through telecommunication services like telex, telephone, satellite communication networks, etc. So this foreign exchange transaction mostly it takes place over the phone. So here there are two segments, that is wholesale segment and retail segment with respect to transactions. When transaction takes place among banks, that is called wholesale segment. That is foreign exchange transaction that is taking place among the banks is called as wholesale segment, and between banks and customers that is called as retail segment. So the next feature of Forex market is the size of the market. As I already mentioned, it is the largest financial market in the world and it provides turnover of about $5 trillion. This is pretty old data, that is dating back to April 2013, but still it provides huge turnover. This Forex market, it was primarily set up to facilitate this settlement of debts which is arising out of this international trade. But now it has developed so much that the average turnover, that is the 3 days turnover in this foreign exchange market, will be equivalent to the magnitude of world trade in goods and services. Okay, so all the turnover that is combined together of the world's trade in goods and services will be equivalent to 3 days turnover in this Forex market. That much it has grown and that much it provides turnover to the world. And the largest Forex markets are in London, followed by New York, Tokyo, Zurich, Frankfurt. And here if you take foreign exchange business in India, it has, comparing to the older days, now it has increased a lot. There is increase in volume of foreign trade, there is improvement in communication, and also there is greater access to international exchange. But still, comparing to the world's transaction, it is less in India. There are quite reasons here why this transaction is not that much in India, why there is not that much turnover in India is that major reasons is rupee is not internationally traded currency and there is no great demand for it. Second, most of the transaction, most of this external trade, it takes place in these major currencies, that is US dollars, pound sterling, euro, Japanese yen, Swiss francs. All these currencies are actively traded in the Forex market comparing to rupee. So that is the reason why this volume of transaction is not that much in India comparing to the rest of the world. Next one is 24 hours market. As the name itself suggests, it's open 24 hours in a day. That is, it is according to the time zones of the globe. When one market closes, the other market opens, like that. In form of rotation it happens. So major markets are situated in Sydney, Tokyo, Hong Kong, Singapore, Bahrain, Zurich, Frankfurt, Paris, Brussels, Amsterdam, London, New York, Montreal, Chicago, San Francisco and Los Angeles. So these are the areas, these are the places where major markets are situated, and specific markets among these, they operate only during business hours. That is, during banking hours only they will operate. Once the banking hour is over, this foreign exchange transaction also do not take place. Especially in India, same thing applies. Only during regular banking business this foreign exchange transaction is also open. Other than that it will be closed, and mostly no transaction will take place on Saturdays. Next one is efficiency. So efficiency of forex market, if you take, there is development in communication and also information, that is what are all the current happenings taking place. All these will be available in Dow Jones, Teletrade and Reuters. So with this, the efficiency, these two things, it largely it contributes to the efficiency of the market, as well as when there is a significant development in one market, it will quickly spread into the other markets as well, thus creating a global impact. So last feature of this forex market is the currencies traded here. As I already said, US dollar is a major currency which is being traded in this forex market. It is also called as vehicle currency. So its contribution to forex market is 87%, followed by euro 33%, Japanese yen 23%, and in pound sterling 12%. So most traded passive currencies are these. Traded passive currencies are nothing but the currencies which are bought and sold. Okay, so mostly they buy US dollars and they sell euros, or they buy US dollars and they sell Japanese yen. So these are the paired currencies. Next one is participants in this forex market. So the participants comprise of corporates, commercial banks, exchange brokers and central banks. So now we are looking into participants. The first one is corporates. So corporates here refers to business houses, international investors and multinational corporations. So these corporates, they buy or sell currencies either to speculate or trade in currencies, that is within the extent to which they are permitted by this exchange regulations. Beyond that they cannot act. So these corporates, they have to place their dealings with commercial banks. These banks help them to carry on these transactions. So here the deal is between the bank and its clients. Clients are nothing but these corporates. We already saw this concept of two segments of transaction, that is wholesale segment and retail segment. Wholesale segment, transactions among banks. Retail segments, transaction between bank and clients. So these corporates, they fall under retail segment. So and then with respect to those unutilized portion of foreign exchange, these need to be surrendered to the authorized dealers. Okay, so any person who hasn't utilized this foreign exchange, those unutilized portions need to be returned to the foreign exchange dealers, that is authorized dealers. So the 60 days, 90 days and 128 days, it all speaks about the days within which each foreign exchange which were purchased for particular transaction need to be returned. So if any person who has purchased this foreign exchange and haven't utilized it, he has to surrender those unutilized portion within 60 days from the date of purchase. And in case of foreign exchange which was acquired for travel abroad, in that case those unspent foreign exchange should be surrendered within 90 days from the date of return to India, when the foreign exchange is in the form of foreign currency notes and coins. And in case of traveler's checks, it need to be returned within 180 days. So these are all the facilities which is being provided to the corporates and how they can deal with the foreign exchange market. Next one is commercial banks. These banks, they are the major players in the market. They buy and sell these currencies either for their own purpose or on behalf of their clients. So here there is a concept called as cover operation. It's nothing but when a bank enters into a market in order to correct the excess transactions or sale or purchase transactions, that is in foreign currency, on behalf of their customers, that is said to be cover operation. Okay, so when there is excess transaction or sale or purchase transaction in foreign currency, in that case these banks, they enter into and make sure they correct that for behalf of their customers. So that is called as cover operation. So this cover operation, such transactions, it constitutes hardly 5% of the total transactions that is done by these large banks, and then major portion of the volume is accounted by trading in currencies. That is nothing but, in this case, commercial banks, they indulge in this transaction, that is in trading transactions, that is mostly in these major currencies. With those transactions only, they will be able to gain from exchange movements. Because of that, they mostly trade in those currencies, which helps them to gain from exchange movements. And as we already know, transactions, it is of two kinds. One is large, the other one is small. In case of large transactions, these banks, they directly deal with. In case of small transactions, these foreign exchange brokers, they will be involved. Next one, exchange brokers. So exchange brokers, they again facilitate deal between banks, that is they help in this foreign exchange transactions. So now in this case, when these exchange brokers are absent, in that case what happens, banks, they have to contact other banks, each other banks for the quotes. It's nothing but, if suppose the center, okay, this market is consisting of 150 banks, in that case, in order to get the best quote for a single currency, this bank has to contact 149 banks for the best quote. If suppose exchange broker is not there, when exchange broker is there, he himself will take care of that. He makes sure that the bank gets most favorable quotation, that too at low cost in terms of money and time. So banks, it will leave with the broker the limit up to which and the rate at which it wishes to buy or sell the foreign currency comes on. Even though that decision is given to the brokers, again all these contracts and transactions will be under the control of the banks, because exchange brokers are acting on behalf of the banks. And in case of counterparties, so we all know these exchange brokers, they help us to buy and sell foreign currencies, and then counterparties are nothing but parties to the contract. So till the contract or till the deal is finalized, these counterparties will not know each other. It will remain anonymous. Once the contract is acceptable, in that case only the counterparties will be known to each other. And then these exchange brokers, they not only specialize in major currencies, they also specialize in exotic currencies, those currencies which are not that much traded in the market. Even in those currencies they specialize in. And then with respect to India, banks, either they deal directly or through recognized exchange brokers. So recognized exchange brokers are nothing but accredited exchange brokers, those who are permitted to contract this exchange business on behalf of authorized dealers in foreign exchange. Okay, but only on an understanding that they have to conform only to this particular rates, only to this particular rules and conditions that is held by FEDI. Only on that basis these people will be allowed to work on behalf of the authorized dealers. and this clause is nothing but each and every contract which they are entering into should have this clause which says subject to the rules and regulations of the FEDI. They have to abide by this clause, only then the contracts becomes valid. Next participant is central bank. We all know for India it is Reserve Bank of India. So central bank, they interfere in the market to influence the exchange rate. Okay, they don't unnecessarily enter into the market. In order to influence the exchange rate, they enter, and the central banks either they transact for their own purposes or on behalf of the government they will act. That is, they buy and sell these bonds and settle transactions that involves foreign exchange payment and receipts. So in India, these authorized dealers, they have recourse with the Reserve Bank of India to buy and sell US dollars to the extent Reserve Bank is prepared to transact in that particular currency. So Reserve Bank, it will not ordinarily buy and sell currencies from or to authorized dealers. As I already said, only if any need arises they enter the market. So the contract they entered in the contract which they enter into with these authorized dealers, it will be taking place on business hours, and no transactions will be entered into on Saturdays. So here in this case, the value date for spot as well as forward delivery, it should be the date, the transaction date, it should be in conformity with the national and international practice. And Reserve Bank of India, it doesn't enter the market in the ordinary course. Okay, only when there is any problem happens, or if it wants to transact, if it want to either buy and sell bonds, or if it wants to make foreign exchange payment and receipts, in that case only it will enter. So whenever this exchange rates, it is moving in a detrimental way due to these speculative forces, in that case also Reserve Bank will intervene in the market. Either directly it will intervene in the market, or through State Bank of India it will intervene and make sure this exchange rate, it moves properly and not in a detrimental manner.